Which is how to minimize tax. We have many different ways of minimizing tax, and tax is a huge burden on most of us. It can take 30 up to 50% of our income, and what we want to do is we want to minimize tax. A great way to minimize tax-free savings account is you can invest completely tax-free. I always say people should have at least both of the RSPs and your TFSAs. But if you have more money, then you can put into a TFSA, because it is capped, as is your RSP. Another investment could be what's called corporate class investment. Now, corporate class does not mean you have to be a corporation, but it is a way of sheltering your money, deferring taxes. So there's three different ways of earning money from investment. One is interest, which is fully taxable. The other is dividends, which it's tax preferred, and you are taxed on it every year. And then there's capital gains. The income is taxed at 50% of the marginal tax rate, and it's when you choose to take that capital gain. So I'll give you an example. If you had an investment of $100 and it went to $200, your capital gain would be $100. You would be taxed on 50% of that. And if you look at the highest marginal tax rate, well, the second highest marginal tax rate of 46.1%, then you tax roughly 23%. Literally put a box around your investments. So you can have an investment that bears only interest or only dividends or only capital gains, but it is a box around it, and you can actually move between those different mutual funds without triggering a taxable event. So if you have a mutual fund that is in a non-registered account, if you sell, let's say, the dividend fund to buy the money market fund, you are going to realize a capital gain. But what this does is it allows you to move between funds within the corporate class structure, as long as you, and when you actually take it out of the corporate class structure, or when you actually sell to take it out, it comes out as a capital gain, not as interest. Even if the entire investment only earned interest, you would still only be taxed as a capital gain. So you are going to be taxed at a much more preferred rate. And after 20 years, it is $937. This is after tax. If we put it into a corporate class investment, or the corporate class structure, after tax, it's $1,063,000. So you're making 13% more. If you have $2 and you take that toonie and you double it every year for 20 years, that toonie, if your gains are not being taxed, $2 becomes $4, after 20 years, that is worth $2.1 million. But if you tax that money that you make each year, after 20 years, it's less than $10,000. That's the difference at 50%. I'm saying tax at 50%. That's the difference that tax makes. So if you can defer your tax to a later date, you're going to be far better off. If you're taking dividends out of your business instead of salary, then you're not getting any RSP room. If you want to invest, and you want to invest so that you are deferring your tax like an RSP, a corporate class structure is the way to go. If you have retained earnings within your corporation, you can also invest in a corporate class structure, because retained earnings, if you're making passive income would be in a corporation is considered rental income and investment income. You're being taxed at 46.7%. It's almost 50%. So if you can put your investments in your retained earnings in your corporation, in the corporate class structure, and then you can dividend out later, you're going to be much further ahead than if you had left it and you were investing in a non-corporate class structure. So the corporate class structure works very well. You can sell everything out, as I said, at the end of it, but we also have what's called a T-series, meaning you can take money out on a monthly basis, and what it does is it comes out as return of capital. A lot of tax. We want to get something back from it. It's up to your accountant or your financial advisor to help you minimize your tax. I'm not sure if the banks do or not. So it's just a matter of if you have a non-registered investment, and if you're with me, it will likely be in a corporate class structure.